In late February 2026, a coordinated U.S. and Israeli air campaign struck deep into Iranian territory. The tactical mission successfully targeted nuclear infrastructure and executed a decapitation strike against the state's senior leadership. Standard military threat assessments measure conventional hardware, counting tanks, planes, and missile stockpiles. They completely fail to account for the extreme fragility of the hyper-globalized, just-in-time logistics networks that actually keep modern nations alive. To understand how a contained military engagement mutates into a global crisis, we are going to run a 6-month simulation tracking the cascading effects of this exact scenario. The initial airstrike failed to neutralize the enemy. It simply started a 180-day countdown to American imperial collapse. During the first 2 weeks, adversary forces bypassed the U.S. Navy entirely. By launching cheap drone strikes on just 3 commercial tankers, they weaponized the global maritime insurance market. War risk premiums surge, indemnity coverage vanishes, and 20 million barrels of daily petroleum transit halts because the Strait of Hormuz becomes commercially uninsurable. The 1973 Arab oil embargo removed about 7% of global supply. This 2026 disruption removes nearly 20% of global petroleum consumption and a fifth of the world's liquefied natural gas, or LNG. The point of no return arrives in late month 2. Retaliatory strikes sideline Qatar's export capacity, halting physical LNG deliveries to Asia. Because gas lacks deep physical storage capacity, import-dependent nations operate on razor-thin margins. Taiwan, for example, exhausts its 11-day energy reserve almost immediately. Forced to ration power, advanced semiconductor fabrication plants in Taiwan and South Korea shut down. This sudden unavailability of microchips paralyzes the American automotive, technology, and defense manufacturing sectors, severing the digital supply chain at its root. As physical supply chains shatter, energy prices skyrocket. The resulting inflation triggers massive margin calls for leveraged investors. This instantly freezes the $16 trillion repurchase agreement or repo market, the highly sensitive short-term funding system that financial institutions use to lend cash to one another overnight. Desperate to raise cash to cover their margin requirements, financial entities begin indiscriminately selling off highly liquid assets, dumping U.S. treasuries and blue-chip tech stocks. Seeing the panic, domestic banks retreat, leaving leveraged traders exposed and drying up credit entirely. We saw these exact mechanical failures during the 2008 financial collapse, where frozen credit quickly wiped out consumer resilience. Here, the stock sell-offs and frozen lending obliterate everyday credit availability, just as the cost of living hits historic highs. The Federal Reserve is caught in a stagflationary trap. They cannot print money to provide liquidity to the banks without sending the energy-driven inflation even higher. With standard monetary policy rendered useless, the domestic economy begins to suffocate. By month 3, the conflict shifts back to the military domain. The U.S. relies on rigid, centralized aircraft carrier strike groups. The adversary counters with a decentralized mosaic defense doctrine, deploying localized swarms of cheap, explosive-laden fast attack craft and loitering drones from hidden coastal inlets. This chart illustrates the grim math of cost imposition warfare. The blue bar shows the multi-million-dollar price tag of a single American interceptor missile. The red bar shows the few $1,000s it costs to build an asymmetric drone. The U.S. is forced to exhaust its incredibly expensive, finite munitions to destroy easily replaceable targets. The U.S. military cannot simply buy more interceptors. Over the last 2 decades, private equity firms loaded thousands of critical defense contractors with massive debt. When the domestic credit markets froze back in month 2, these heavily leveraged suppliers began filing for bankruptcy en masse. The military suddenly finds itself unable to procure software updates or replacement parts. Missions are aborted mid-execution as equipment fails without the possibility of resupply. Financial engineering has hollowed out American hard power, leaving expeditionary forces grounded by severe operational friction. Watching the U.S. military bog down and domestic supply chains fail, global allies quickly realize the risks of continued alignment. Seeking to secure their own economic survival, they quietly abandon Washington to strike bilateral energy deals with the expanding BRICS Plus coalition. There is a historical precedent for this kind of engineered global shift. During the 1956 Suez Crisis, President Dwight D. Eisenhower deliberately dumped the British pound onto global markets. By weaponizing the financial system against an overextended ally, he forced a run on the Bank of England and bankrupted the British Empire. In month 5, the BRICS Plus coalition runs this exact playbook against Washington. Foreign central banks initiate an aggressive, synchronized liquidation of U.S. Treasury bonds, flooding the market and shattering global demand for the dollar. This massive capital flight forces developing nations to operationalize alternative financial architectures, like local currency trade and digital settlement platforms. Gulf exporters agree to price energy in the Chinese renminbi, creating the petro-yuan, and officially terminating the era of U.S. dollar hegemony. This chart details the mathematical reality of imperial overstretch. With the national debt surpassing $38 trillion and bond yields spiking from the massive global sell-off, the cost of servicing that debt skyrockets. As you can see, the red net interest slice rapidly expands to consume the entire federal defense and social budgets. On Main Street, the consequences are immediate. Grocery costs spike 30%, and unmanageable mortgage rates hover near 7%, completely destroying the purchasing power of the American working and middle classes. Extreme economic scarcity and supply shortages ignite massive domestic unrest. The volatile intersection of an unpopular, deadlocked overseas conflict and severe economic strain perfectly mirrors the chaotic societal breakdown seen during 1968. Desperate to maintain order, a financially bankrupted federal government deploys acting military troops into American cities. State governors, reacting to the extreme distress of their constituents, refuse to comply, escalating into physical, armed confrontations between state-aligned law enforcement and federally directed units. Superpowers fall when their own vast complexity, crippling debt, and imperial overextension are turned against them by patient adversaries.